Going back to our flow of accounting data, the next step after we prepare financial statements is to close our books. Closing the books prepares our accounts for the next accounting period. So we close the books at the end of the accounting year after we prepare our financial statements. And what we do when we close the books is set our revenue, expense, and dividend accounts to a balance of zero. Revenues, expense, and dividend accounts are called temporary accounts, and those accounts are closed when we close the books. Your assets, liabilities, and equity accounts, basically everything you find on your balance sheet, are permanent accounts, and you do not close those accounts. Those balances get carried forward from one year to the next. Again, when you close the books, your temporary accounts are closed, your permanent accounts are not closed. How do you figure out which ones are permanent and which ones are temporary? If you remember, all the balance sheet accounts, whatever you find in the balance sheet, are permanent accounts. They are not closed. They get carried forward from year to year. The balances get carried forward from one year to the next. The closing journal entries are described here. So to close out revenue, what you would do is debit all the revenue accounts you have. All this time we've only seen one revenue account, but sometimes if you've got multiple revenue accounts, you would debit each revenue account and credit retained earnings. To close out the expense account, you would debit retained earnings and credit each expense account. And then to close dividends, you would debit retained earnings again and credit dividends. Let's take a look at an example to help you understand the closing process. In this example, it says that the following ledger accounts are presented for Vincent Corp. Close the books to prepare the accounts for the following period. So these are a list of all the T accounts, all the ledger accounts for Vincent Corporation. What they have is they've got balances for cash, dividends, equipment, revenue, common stock, accumulated depreciation, rent expense, salary expense, and retained earnings. The balances presented here are the balances that are at the end of the year after your adjusted trial balance and after preparing your financial statements. Now, this is the last thing we would do, which would be closing our books. Remember, when we close the books, what we do is we clear out all the temporary accounts. Your temporary accounts are your revenue accounts, your expense accounts, and your dividend accounts. Let's start with the revenue accounts first. So for revenue, we have $50,000 credit in our revenue account. We got to close that out. Closing it out means setting the balance to zero. How would we make the balance on our revenue account go to zero? We would have to debit revenue for $50,000 and we would have to credit retained earnings because by definition we close it out to retained earnings. When we do that journal entry, what we do is we zeroed out our balance on our revenue account. We have closed our revenue account. Next, let's take a look at the expense accounts. We got two expenses here, rent expense and salaries expense, and we're going to close it out. Again, closing out means setting the balances to zero. How do we do that? They both got debit balances, so we need to credit an equal amount to make those balances go to zero. We're going to credit $12,000 to rent expense, $15,000 to salary expense, and then we can add both those totals up and debit retained earnings for $27,000. By doing that journal entry, what we did was we brought the rent expense balance to zero and the salary expense balance to zero. We've closed out our expense accounts. Now we've got one more temporary account that we need to close out. That is dividends. Dividends has a debit balance of $1,000 here, and we close it out by crediting dividends for $1,000. We credit dividends $1,000 and we would debit retained earnings for $1,000. Now we've closed out all our temporary accounts. All the remaining accounts that are shown here, cash, equipment, common stock, accumulated depreciation, and retained earnings, are all found on your balance sheet and they are permanent accounts. They do not get closed out. These balances get carried forward to the following accounting period. Now that we've closed out the temporary accounts, let's take a balance for our retained earnings account. Our retained earnings account has a balance of $25,000. If you go back to your financial statements, and I know we didn't do financial statements for Vincent Corp, but that $25,000 retained earnings ending balance in your ledger account will be the same as the retained earnings balance on your balance sheet and the retained earnings balance in your statement of retained earnings, the ending balance of retained earnings in your statement of retained earnings. Now that we've closed the books, we are ready to start our next accounting period. We've prepared the books to start our next accounting period. Sometimes companies take a post-closing trial balance to make sure that they have closed their books correctly. What you do is take a trial balance, and your trial balance will have only your permanent accounts. So you will have cash, which we didn't close out, equipment, didn't close out, accumulated depreciation, common stock, retained earnings, and when you total up your two columns for your debits and credits for your trial balance, they will equal. Remember again, what we have after closing would be only the permanent accounts.